Welcome, everybody, to our investor update. I'm John Momartz. I'm along with Bob Key. I'm in Marquette. Bob is in Boston today. Today is Wednesday, October 26th. And before we start, we just have a brief investor update on what our thoughts are today. But what I want to do before we get into that is give you a little bit of the history of the trades that we've done this year. As you all know, our goal is always to be fully invested at all times, but we use relative value as a way to move from one asset class to another, depending on overvalued asset classes and undervalued asset classes. And it's been a very challenging and volatile year. So we've made a lot of moves this year, and I just want to recap because these moves have paid off, even though portfolios are down based on where the market is year to date. Our portfolios on average are down quite a bit less than the market. So it's probably worth rehashing kind of what the process that we went through to get to where we are today is. So just real briefly, in January, of course, we knew the Fed was going to start raising interest rates considerably. So in the very first week of January, we cut our government bond allocation and moved those proceeds to cash. In March, we again reduced our bond allocation, moved more cash. April, we actually reduced cash and bought large cap value stocks. And really for that time, all the way through the summer, the market moved up fairly nicely. So that the timing on that was worked out very well. And then in June, we reduced our bond allocation again and bought some more cash. So our cash position was still fairly high. In July, we did it again, sold more bonds, bought more cash. And then in August, we saw that big run up in the equity markets and we sold those large cap value stocks and we went in and bought some high yield bonds and some investment grade bonds. And then just most recently last week, we reduced some of that cash position that we had built up throughout the years and we bought some more high yield bonds and some investment grade bonds as the spreads have improved so dramatically that it was hard to resist the yields and the potential returns that we could get from those positions. So with that, those trades have dramatically improved or minimized the losses that we could have had otherwise. So with that, I'd like to introduce everybody to Bob. And Bob, you want to take it from here and give our thoughts on where we're at?
Sure. The overriding theme, I guess, for this whole year has been the spike in inflation and what is the Federal Reserve going to do about it. So it wasn't until March that the Federal Reserve actually started raising the Fed funds rate. But they almost January 3rd was the day that they came out. That's when markets peaked and they just gave a very hawkish statement about what they're going to do about the increase in inflation. So we can see that when we look at inflation, that inflation has certainly spiked quite a bit. Importantly, though, we seem to have peak inflation behind us. It continues to move down. It's moved down pretty much everywhere with the exception of the services sector. We actually have an interesting employment cost index number coming out Friday that will show us where service or wage inflation is at. But that's the one area that is still being stubborn. The good news is when we look at goods, supply chains are catching up. We see durable goods lower. We had talked before about the importance, if you're looking to buy a car or a truck, those numbers are all kind of catching up as semiconductors catch up in those areas. But, as a general rule, prices are coming down with the very, very notable exception of employment. Employment cost is still higher. Labor cost is high. So one of the things that we really look for is credit crunches. When we look at the economy and we see these interest rates going up, what we really want to be cognizant of is, what happened in 2008, what's happened in prior deep recessions, where because we have overextended credit, both corporate and personal credit, as interest rates go up, the debt service on that additional interest goes up. What we've seen so far this time is that I think 2008, 2009 are still fresh in investors' minds. Tightening lending standards are much tighter, and we really don't have an extended amount of credit out there. So we're not nearly as worried right now about these higher interest rates as we would have been in prior run-ups in interest rates where we had much more credit outstanding. You can see that debt ratios remain very reasonable. And then, so again, the ability to pay off the debt that companies have and that individuals has is reasonable despite these higher interest rates. So as we look at this is the 2-year Treasury yield relative to Fed funds target rate. We can see how much that has moved up. One of the reasons, the primary reason I would say that if we look at this 2-year rate is that John mentioned that how much we've lightened up our duration. That's a word for interest rate exposure. You'll notice that interest rates move up considerably time-wise. They move up about 3 to 6 months before the actual raise in interest rates of the Fed funds target rate. We're really seeing ourselves getting to the end of this tightening cycle. Of course, nobody knows exactly what the Fed is going to do. We expect 75 basis points here at the meeting at the beginning of November, and then another 75 in December, and then probably a pause. It's very likely that interest rates are going to start moving lower, and have even this week moved lower as people anticipate the end or a pause to the Fed tightening cycle. Treasury yields also, 10-year Treasury yields, quite a bit higher, up around that 4% range right now. It's really the most attractive yields we've seen in 2 decades. So it starts to make sense for us to start to add back duration risk, interest rate risk, and credit risk into these portfolios as these yields become much, much more attractive than they've been in a long time. This is the yield on the yield spread, I should say, on high yield. One of the things people think about interest rates as being just interest rates moving up or down. With corporate bonds, what happens is corporations pay a premium or a spread to the Treasury yield because there's a default risk with corporations. You can see that, that all you were getting when everything was stable and wonderful, you're getting only about 250 basis points or 2.5% above what you get on Treasury. When you bought high yield bonds. Right now, you're getting 6% more than you get on Treasury by buying high yield bonds. That brings the high yield bond rate up to 9%. I mean, a good way to think about a 9% yield on a high yield Treasury, it spiked up to that level during COVID for just a few days and came back down. But really, again, we have not seen these levels in almost 20 years. So, it's a really, when we look at asset classes, right? Unlike stocks where you look at economic variables and you forecast earnings, et cetera, what you look at is your naive assumption. You look at the long-term averages of those. Your naive assumption on bonds is that the current yield, if nothing happens, will be your return. So simply put, if spreads did not widen or tighten and interest rates stayed where they are, you would make 9% by owning high yield bonds over the next year. So, that's the investment summary. The general theme we have is that we have entered what we would call a period where we expect to be putting risk back into the portfolios. As John mentioned, we've really took down our risk considerably. We're still underweight at the aggregate level risk. That's helped out the portfolios a lot. We see as the Fed reaches the end of their tightening period, we believe, as inflation has peaked and is starting to move lower, and we still see corporate earnings and the economy growing, that we expect to be rewarded by adding risk back into these portfolios. And we're going to systematically do so, and we'll probably be back up to neutral risk sometime in early to mid 2023.
Well, with that, thank you all for listening in. As always, we appreciate your trust in us, and the whole MMFS team looks forward to talking and meeting with you all regularly, and we'll be in touch with our next communication very soon. Have a great day.
Thank you, everyone.